Taylor Riggs in for Emily Chang, and this is the best of Bloomberg Technology, where we bring you all of our top interviews from this week in tech. Coming up, Tesla's turnaround. At least one analyst says it indeed looks credible. We'll hear from Dan Ives of Wedbush, who's raised his price target on Tesla to $370 from $270. Plus, 2020 picks. We're covering all of big tech in the new year with Wall Street's most watched analysts, Ives, and RBC's Mark Mahaney on why they like companies like Facebook and Apple. And tech regulation, legal and legislative hurdles continue for technology, especially for overseas apps like TikTok. We'll hear from Senator Marsha Blackburn on how much more needs to be done. We begin this hour with Tesla. Its stock has been on a runaway rally the latter part of the year. Last week, we saw shares breach CEO Elon Musk's goal of $420. Analyst Dan Ives of Wedbush recently raised his price target by $100 to $370. He joined to discuss whether Tesla's turnaround is working.
Look, I think right now, if you look back at the last 6 months, it has been massively impressive what Musk and Freeman have been able to do in terms of turning this around from a demand and also profitability perspective, with Europe being front and center. Look, I view the stock sort of as a base and bull case. So base case, 370. Bull case is 580 to 600. So if they're able to execute over, especially over the next quarter or two, and this China thesis really starts to, I think, the upward trajectory in terms of Giga 3 as well as demand, then you could start to see a stock go much higher. So for us, it's more, this gets us to a base case. I think bull case is 580 to 600, and I think a lot of that really rests on China.
Dan, I've spoken to a few neutral/bearish analysts in the last few weeks, and they really are concerned about demand over there in China. Do you have any sense of what could be a bear case if something were to happen, maybe the economy starts to slow? What would need to happen for you to turn a little bit more bearish?
Yeah, I mean, ultimately, if I look at the work we've done in Asia in terms of on the ground there and just overall demand, the question is, how quick could you get to 100K units in China? Could that be quicker than the US or Europe? And I think if the answer is yes, then I think this is something that could really take the story to the next level. I think in terms of the bear thesis, it's ultimately you hit some sort of regulatory roadblock in China. Giga 3 hits a snag, or you have competition that slows down the underlying demand story in China. And that would really be the bear thesis. But I can tell you right now, as someone that's been skeptical, as me and you have talked about many times over the last 6 months, Musk, Fremont proved us wrong, and I think many of the bears, to what they've done over the last few quarters. Got to give them credit. Stocks obviously had a parabolic short squeeze, but China really is the key to the next leg of the growth story.
So much of the bull thesis relies on demand on the Model 3s, but that is the least profitable of all the models. At what point do you need to start to see demand shift to some of the other more profitable models?
Yeah, and if you look, obviously Model Y will come out next year. And you look at some of when you look at S and X, I mean, that's really started to tail off in terms of overall demand. And I think what's really been the key to the Tesla bull thesis, and really the stock going from 300 to now 430, it's really the profitability. I mean, they have done a great job. It was in Fremont as well as in Giga, really getting a profitability on core Model 3 and what that trajectory looks like. But I do agree, you need to see it's really software and sort of upticks within the actual versions. You need to see that software versions from self-driving to others. That's an extra 5, 7, 10K per car. That's all profits, goes to the bottom line. So that's really going to be the key, that gross margin story for Tesla over the coming quarters.
Now, Dan, I've stayed with me as we had a lot to discuss regarding Uber, the company co-founded by Travis Kalanick. This week, Kalanick cut his last ties to Uber. On Tuesday, we reported that the 43-year-old stepped down from Uber's board. He also sold all of his remaining shares in the ride-hailing giant. Kalanick was ousted as CEO in 2017 following months of chaos and controversy. Kalanick says he now wants to focus on new business and philanthropic endeavors. I asked Ives and Bloomberg senior executive editor Brad Stone about the moves.
It doesn't simplify things any more than were simplified back in 2017. You know, when Travis was ousted from the CEO spot, went to the board. Now, I guess, he was the largest shareholder and he was on the board, but, clearly focused more on his new company, Cloud Kitchens. He started selling the stock in early November after the post-IPO lockup expired. So this is a little bit of a sort of slow-moving divorce. But, from what I hear, Travis's voice wasn't, all that loud in the last 2 years. So it really just codifies things that have been underway since he lost the top spot.
Dan, do you agree? Did anything change for you on Tuesday on this announcement?
Look, I think ultimately it just ended a dark chapter. I mean, you're talking about someone that sold, almost $3 billion worth of shares. It's been an overhang on the stock, and I think it would have been awkward if he stayed on the board. And I think fundamentally it just speaks to Uber really being a train wreck since the IPO, and this was sort of the final chapter. Now for investors, the hope is optimism going to 2020, but Dara, there's a lot of pressure on him to succeed. I think a fork in the road situation for Tesla as we go into 2020. But when you look at Uber, I mean, that fundamentally, that's the issue right now. Look at some of the issues they faced. And I think right now there's a lot of worries, going into 2020.
Brad, you're nodding your head. What are some of the issues that Uber is going to be facing?
Well, it really boils down to one issue, which is profitability. I mean, this is a company that's still losing billions of dollars. It's 12 years old. Its core market, ride sharing in North America, growth has slowed. And so investors really want to see growth in some of the newer geographies, and also Uber Eats, now around 20% of Uber's growth bookings. So it really comes down to, is this a business that can be profitable and keep growing? And Dara Khosrowshahi, who's now been the CEO for 2 years, put a stake in the ground. Profitability is around the corner, but investors want to see it get there.
Well, Dan, investors do want to see it. And if you want to come and take a look at a chart here that I'm showing inside my terminal, it is Uber and Lyft, both down now 30% since the IPO. Uber, though, I would note, has sort of been on an uptrend early to mid-December. Dan, in your case, what's the bullish thesis for Uber?
Look, I mean, for Uber right now, it's that you look at growth of underlying, not just drivers, but users in terms of penetration, 2 to 3% today. I mean, the opportunity is to monetize that going forward. If you look at growth and then profitability in 2021, but I think when you look at Uber Eats right now, I think that's what I view as about an $8 to $10 overhang on the stock. So then the question right now for Uber is, do they cut that business or at least significantly get to a point of profitability? Because it's really been an anchor on the ship. So for Uber, there's an opportunity to sum of the parts. You look at everything they've done in autonomous, but for investors right now, it continues to really be a heartburn situation because of execution, overhang, I think, as well as just miscommunication with the street, and it's really been that trifecta.
That was Bloomberg's Brad Stone and Wedbush Managing Director Dan Ives. And with just a few days left until 2020, Dan Ives will tell us what his top calls are for next year. That's next. And if you like Bloomberg News, check us out on the radio. You can listen on the Bloomberg app, Bloomberg.com, and in the U.S. on SiriusXM. This is Bloomberg. Now we're coming up not just on the end of a year, but the conclusion of a decade, and big tech has definitely made its mark. I spoke with Wedbush Managing Director Dan Ives Thursday to hear his forecast for 2020.
It's really a continuation of our thesis playing out from this year into next year in terms of the super cycle. I mean, it really comes down to the math. 900 million iPhones worldwide. About a third of those, 350 million, have not upgraded in 39 months. And I think we are going into a super cycle. 5G is going to be on the tail end of that. And I think when you look at that and mining the install base, some of the parts, I think this is a re-rating stock that continues to go higher. I think 350 is base case. I continue to look out 2-3 years. You could see a stock that now starts to approach $1.5 trillion, $2 trillion in terms of that core thesis playing out over the next 2 years.
What if the upgrade super cycle doesn't materialize?
It's a great question, and that I think is the bear thesis is, okay, we've been there before. What happens if 5G is a bust, especially on the first part? I look at right now, if you look at iPhone 11 and you look at the trajectory going into later this year, I can tell you from our work that we've done in Asia, it looks like right now line in the sand is about 200 million units for the 5G cycle. So in terms of suppliers, all indications are that's going to be a real strong product cycle. There could be speed bumps, and I think we'll, of course, hit those in a given quarter going into 2020. But as of right now, the visibility looks as strong as we've seen it. I'd have to go back 5-6 years in terms of where I've seen it. And that's really why we have such a bull thesis here on Apple in terms of not just the Rock of Gibraltar iPhone, but in terms of services and re-rating.
Well, and part of the bull thesis continues to be a supreme balance sheet. And if we go into balance sheet analysis, I'm taking a look at another chart showing, frankly, $100 billion of net cash. That's cash after some of the debt that they have. What is the best use of cash?
Yeah, and they'll generate $60 billion in free cash flow. And I continue to think that they're going to get vertically integrated. They're going to buy more technology within the phone. You saw the Intel 5G acquisition. I could see more of those. But I do think content's going to be what they go after. I believe that they will acquire a studio in 2020. Talk about MGM, Lionsgate, a handful of others that I think would fit the bill because you need, right now, content's key to that services piece. So when you look at the streaming TV service, I think that's something that they can look to acquire. They're going to continue to do buybacks significantly, but I do believe Cupertino gets more acquisitive in 2020.
Dan, I want to flip on over to another stock that you cover, and it's Microsoft. And according to the Bloomberg terminal, you still have an outperform rating on Microsoft. I keep hearing that their Azure cloud product is poised to benefit more so even than Amazon from the shift to cloud. Do you agree?
That continues to be why it's our top pick along with Apple, and really it's been there since Nadella took over. Nadella, in my opinion, covering tech for 20 years, it's one of the most jaw-dropping turnarounds I've seen for any tech company because right now Microsoft is the cloud play. And I think they've further narrowed that gap with AWS. Look at the Jedi deal, it's just a good example of that. So I think on the first phase of cloud, it was Amazon and Bezos. They won that. The next phase, it's Microsoft. And that's why, in my opinion, this is a re-rating stock. Numbers continue to go higher. And that's why I think this is one, we're only halfway through this cloud story playing out for Azure and Redmond.
That was Wedbush Managing Director Dan Ives. For more 2020 predictions on the tech sector, I was joined by Mark Mahaney of RBC Capital on Monday.
It's our Facebook of 2020. It's a dislocated stock. It's unpopular. It's a failed IPO. It's got this Eats business that's losing a lot of money. Nobody wants to buy Uber. We think the story is going to get better and better as we go through the year. So dislocated stock is more likely to have upside like Facebook did. We think the economics are starting to prove themselves out in the ride-sharing business. And what this company has to do is bring down operating losses each and every quarter. We think they will. And we think by the end of 20 and going into 21, we could have a break-even quarter. And you want to buy a stock that's going through that kind of inflection quarter.
And more so than Lyft because of its diversification rather than a pure play rideshare?
I think these are probably joined at the hip. It's kind of hard to see one dramatically outperforming, if not the other. What I find is that shorter-term oriented funds have preferred Lyft because it doesn't have the food business and it's just in the U.S. market. But the flip side of that argument is that Uber has more levers that they can pull to get to profitability. They can sell one of their loss-generating international assets. And they also have 70% market share in the US. Generally, the company with greater market share determines economics. That's Uber.
How do they overcome AB5 in 5-10 days?
I don't know. I don't think that'll be implemented immediately. I think this is going to be a court fight. And we think that it could lead to something like a mid-single-digit percentage increase in their cost structure. So just keep in mind, there's 2 or 3 hedges here. First, Uber and Lyft gave out a lot of subsidies to drivers in order to get them to drive with Uber and Lyft in the first place. If you're giving them benefits, there's less need to give out subsidies. And second is they can pass some of these expenses on to consumers. And third is there's only a small percentage of drivers for these 2 services are actually full-time drivers. Those are the hedges.
I want to come and take a look at number 2 and number 3 top picks.
Okay.
Google and Facebook. With all of the risks, the regulatory hang, the antitrust, Google and Facebook are number 2 and number 3.
I think it's highly, regulatory fears have been rising for a couple of years. You and I have talked about this a couple of times. And I just think we're close to peak regulatory fears. I think it's highly, highly unlikely that these assets get broken up, in which case we've already seen the worst of it. We've seen fines imposed against both companies. And by the way, it hasn't impacted either of their advertising revenue growth rates. The little interesting angle on Google is, as its cloud business has finally gotten scalable and big enough, it may be less of a drag on margins, so you could actually have a positive earnings story out of Google this year. And then with the 2 co-founders kind of stepping aside, we may get more rationality in some of their investment spend in what they call the other bets area.
Are you thinking Facebook is poised to see higher ad revenue growth than Google? Do they start?
Yes. Yeah, absolutely. Sorry, Taylor.
No,
yeah.
Go ahead.
And also keep in mind, we got 2 things coming up this next year. I think they call it a quadrennial year. We got the Olympics and the elections. I think both of these companies are going to materially benefit from that. You're going to have an acceleration in U.S. advertising spend. Facebook and Google are great ways to play that.
Another big tech name noticeably absent on your list is Amazon. Where is Amazon in your bull thesis?
I think there's an overhang there. Look, it's a buy for us. It's a medium buy. It's not a strong buy. Whatever the difference, if there's something in there between a weak buy and a strong buy in the middle, that's where Amazon is. As a long-term asset, it's great. The overhang on the stock is this AWS business, which has been slowing down, margin pressure, greater competition from Microsoft. I think we and investors want to see a little clearing of the air before we get more aggressive on the stock.
That was Mark Mahaney of RBC Capital. WeWork, perhaps this year's biggest IPO flop. We'll explain what happened and see what the road ahead looks like for the co-working space company. Plus, later we'll hear from one of TikTok's biggest U.S. critics on the changes she wants to see from the viral video app. This is Bloomberg. In our series Big Tech 2019 Rewind, we look at the world's biggest technology companies and the challenges they faced over the last year. In less than 1 year, WeWork went from having a $47 billion valuation and being the darling of the venture capital world to needing an $8 billion infusion to avoid running out of money. At the start of this year, there was a big rebrand. We Company was broken up into 3 distinct business lines: WeWork, We Live, and We Grow. In July, Bloomberg reported that WeWork was looking to go public in September and is targeting a share sale of about $3.5 billion. But September came and the company was said to consider a valuation between $20 and $30 billion in its IPO. By the end of the month, the IPO was delayed and CEO Adam Neumann stepped down. In October, SoftBank came in with a $9.5 billion rescue plan for 80% of the company. Then just earlier this month, WeWork clinched $1.75 billion in financing, led by Goldman Sachs. For more on its performance in 2019 and what lies ahead for WeWork in 2020, I got perspective from Red Wallace of Triton Research and Phil Haslett of Equity Zen.
I think that there's been much ink spilled about this situation, but our perspective on it was fairly straightforward, that just the loss profile of the company was so big that investors needed to be able to do work to figure out how they were not going to be losing $2 billion a year, basically ad infinitum. The company, sort of year in, year out, spent about $2 for every dollar of revenue it generated. And so our perspective is that if the disclosure had been different, you could have had a very different reception from the buyers of a stock like that. And then, of course, there were the own goal, sort of unforced errors of the governance stuff. But nothing that we heard from our customers indicated that the core proposition of WeWork was actually objectionable. It was really sort of the way that the offering itself was handled.
Phil, what's your take?
Sure. I think this was the straw that broke the unicorn's back, right? The first company that was trying to go public with $2 billion of losses, 20 times sales, and really kind of gave a reminder to the market that there's a difference between being a technology software company and being a tech adjacent or tech enabled company. This was kind of the big breaker between Lyft, Uber, and a couple other companies that had tech within their product, but were still actually in legacy sectors.
Brett, you mentioned a point that had the information been presented differently, the IPO might have been able to stand a chance. What would you have liked to seen differently in that offering statement?
Well, the tragedy is that the company's since put out all that information. So there's a 49-page deck that they've released of sort of all of the good KPIs that somebody would need to build a model for the company at the unit level. And so, again, it's a little bit heartbreaking to see that they had it all along. They just decided it's really not clear what the reasons were to not give investors the advantages that all of the private investors had looking at the actual metrics, at the unit level for the company. So, I think what Phil said is right in the sense that investors know how to evaluate a SaaS company. And when you have a company that's not something that's easy or customary to evaluate, then you have a sort of burden of proof to give people the things that they would need to do that extra work. And especially at this kind of magnitude, I mean, even if 47 billion wasn't the right number, we were talking about a very large company and a very large transaction. So I think that, sadly, the metrics were all on hand and are now all public.
Phil, had they come out and said we're a real estate company, we don't want to be valued like an overvalued tech company, would this thing have gone through?
I think it would have been successful, but at the same time, they probably wouldn't have been able to raise the amount of cash with the audacious plans they had as a private company, right? I think the story when they got started, 10 odd years ago, was that they really were going to embed technology to reach much more scale, which kind of kept the eye off the ball of this being a traditional real estate company. But kind of what Rhett mentioned, I think what this kind of brings to the forefront is that there is going to be a slew of enterprise SaaS companies that are far more recognizable and comparable to existing things in the market with great margins and revenue growth and hopefully profitability as well, right? That the market's going to get really excited about.
Rhett, we fast forward this conversation to present day. The cost cut measures that you've seen so far, are they enough?
At WeWork, it's really hard
Correct.
to say. It's really hard to say what the sort of day-to-day operating plan is in there now. I think that you have a company that's basically going to be private for some time, even though it's making disclosures beyond what a private company would do. And we've maintained really from the beginning, looking at this company, that there are a lot of very smart, capable, experienced people around the company. And so I'd be surprised, especially with the sort of parade of wake-up calls we've had here, if the company didn't really get itself back on a track that makes some sense, as opposed to the optics that were put forward to the market, when they tried to go public in the fall. I think the other thing we could say about WeWork's, impact on the market is a lot of people were worried it was going to sort of take the tech market down, the tech IPO market down with it. And luckily, I think with Build.com and a couple other names that we've seen recently, WeWork has now been sort of quarantined into being its own kind of thing, whether it's real estate or tech adjacent or whatever it is, but it's not really representative of the kind of mainstream tech companies that I think a lot of people are looking forward to seeing come to the market in 2020.
That was Rhett Wallace of Triton Research and Phil Haslett of Equity Zen. TikTok as a national security risk. U.S. Senator Marsha Blackburn has called it, quote, China's best detective. We'll hear what she says after TikTok made some changes. And Bloomberg Technology is live streaming on Twitter. Check us out at Technology and be sure to follow our global breaking news network at Quick Take on Twitter. This is Bloomberg. Welcome back to the best of Bloomberg Technology. I'm Taylor Riggs. Now, U.S. lawmakers have been after the popular viral video app TikTok for a variety of reasons. The Chinese company has been a target of national security and data privacy concerns, as well as a CFIUS review. One more thing they're concerned about, the fact that TikTok allowed children, starting at the age of 13, to make in-app purchases, something Tennessee Senator Marsha Blackburn highlighted in a letter to TikTok's parent company, ByteDance, saying the app is, quote, paving the way for Chinese government to gain unfettered and unsupervised access to our children's lives. Well, earlier this month, TikTok responded by upping that minimum age to 18. I spoke to Senator Marsha Blackburn from D.C. to find out if that's enough to appease lawmakers.
I'm pleased that they have changed the age. That's an important first step. Having these children streaming these videos, buying these emojis that could be converted to cash by the recipients, it is just inappropriate. We want to protect children online. We want to make certain that apps are age appropriate. So that was a step, and you mentioned the other concerns that are there for TikTok. We're going to continue to work with them. When you look at the facial recognition, the profiling that is done, the concerns on national security, how the Chinese government, Beijing, listen, you can't tell where their commercial sector and their military sector begin and end. They are all one and the same. And China is determined to build a surveillance state that is not only on their people, and certainly we have seen this used on the Hong Kong protesters and also on the Uyghurs. So we know what they would do to us. And when you think about the profiles that they are building of these children and how they would use that 10 or 15 years down the road, it is of tremendous concern to us.
So, Senator, now that TikTok has responded and raised that minimum age, is that enough for you to recommend it, or do you have some other bigger concerns about the Beijing government using that?
We have other concerns. We're going to continue to meet with them and work with them, and I look forward to sitting down with their leadership team in the coming days.
Do you agree that TikTok should be under CFIUS review?
I think that it's appropriate to sit down with them to have this discussion and then to decide if these companies like the Faces app or TikTok, if it is something that should be under CFIUS review. It is the right question to be asking.
You know, Senator, having discussions with leadership is a great way to start. How do you, though, take it to the next level and prevent data in the U.S. and TikTok to be sent overseas to the Beijing government?
Well, and one of the things we discussed today in Commerce Committee was having privacy legislation and data security legislation here in the U.S. You know, you have GDPR, which went too far on privacy there in the EU, and you have California looking at doing their own legislation. But it's time for the U.S. to put a basic federal privacy standard on the books. And this is something that online consumers want. They want the ability, Taylor, to protect their virtual you. They want the ability to secure their identity online. So we had a tremendous hearing, great bipartisan participation, and one of the things I really liked, the entire panel of expert witnesses, they were all female. I think this is one of the reasons for that is because women are so concerned about the privacy issue.
And I did listen to that, so I did see that, and I want to address that. And as we move on to talking really here about big tech, one of the tweets that you had earlier this week was about Google specifically in censoring conservative voices. What are your facts to support that?
when you look at the research work that has been done, and we've done a good bit of this work in our office, other groups have done this, and you look at the groups that are censored, the posts that are censored that go left of center and the posts that are censored that go right of center, and you see that those that are right of center are censored much more heavily than those from the left. And there are plenty of numbers out there that you can look out for this. Indeed, I think one of the significant things as we've worked on this issue, you had a CEO of one of the tech companies say, you know, their employees are in California and they bring their personal opinions into the workplace. It's their worldview. And this is something that needs to be a neutral platform if indeed your social media and your online connections are going to end up being the new public square.
That was Senator Marsha Blackburn of Tennessee. Coming up, Uber was one unicorn that got investors excited about its debut this year. And since CEO Dara Khosrowshahi was brought in to clean up and rebuild the company's reputation, Uber has been more than just a ride-sharing service. We'll explore some of the big tech stories of 2019 next. Plus, how do we prepare to fight more sophisticated cyber threats in 2020? We'll discuss the possibilities also next. This is Bloomberg. Let's get back to our year-end series Big Tech 2019 Rewind. Big tech companies like Facebook, Twitter, and Google headed to Capitol Hill to testify in front of Congress in regards to potential regulation. The biggest tech unicorns headed to New York to hit the public markets, while others had less success. And of course, the year wouldn't be complete if we didn't mention the streaming wars. One of the biggest trends to date is cutting the cord. There's an endless amount of content to watch if you're streaming, and the list doesn't seem to be getting any shorter. By mid-2024, the most valuable companies on the S&P 500 will introduce their own streaming services. They're spending billions of dollars in order to compete with established players Netflix, Amazon, and Hulu in what's become known as the streaming wars. Disney Plus and Apple TV Plus kicked things off in November. At $6.99 a month, Disney Plus costs about half as much as Netflix and offers a library of programs designed to be irresistible to families. Apple TV Plus is cheaper at $4.99 a month, but only a small library of original programs headlined by a drama called The Morning Show. Two other services to watch out for mid-2020, HBO Max from AT&T and Peacock from Comcast. So why now? The more people cancel their cable and satellite subscriptions and the higher Netflix's stock rose, the harder it got for those companies to ignore the change in viewing habits. In an October poll of U.S. consumers with broadband internet by Hub Entertainment Research, 63% said they watched their favorite show online. And with U.S. producers making at least 100 more shows per year now than in previous years, the pace doesn't seem to be slowing down. As for the performances of big video streaming services in 2019, Bloomberg Technology's Kurt Wagner got perspective from Rich Greenfield of Lightshed Partners and Greg Portell, head of Global Consumer Industries and Retail Practice at A.T. Kearney.
I think that's the real fallacy. I mean, we like to call it streaming wars, and I think the press and sort of the industry likes to talk about one of these eating into the other. But the reality is, we're going to see an explosion of streaming services. The consumer wants to stream video. You've seen it, obviously, with what's happened with Netflix and Hulu and Amazon. But even look at YouTube and look at how much time is being spent. And you've got Jeffrey Katzenberg introducing Quibi next year, which wasn't on your list. But everywhere you look, that there's more and more content. People want to stream content. The reality is the consumer is spending right now $80 to $100 a month for linear TV packages. You've still got 85 million subscribers to multi-channel television. My guess is that the number of homes that actually have to have sports and news, and the only way they can get that is through a linear TV package, that's 40 to 50 million homes. And so you've got 30 to 40 million homes that are going to come out of the pay TV bundle, the big kind of cut the cord type bundling. and they're going to find new ways of getting content, and whether it's Netflix or Amazon or Hulu or Disney Plus or Apple TV Plus, all of these are far easier and cheaper to subscribe to than cable was. You can sign up, you can cancel, you can have a few of them for a period of time. This really empowers the consumer to create the bundle that they want versus being forced to take channels that they never wanted. I mean, how many people are paying $9 to $10 a month for ESPN and never ever watch it?
Greg, I do feel like this can be somewhat confusing to the general consumer when you think about all these different players, all the different price points. Obviously, some of them are already advertising, but they're not yet available. I'm wondering, are these streaming services doing a good job of actually marketing themselves, and how is that actually playing out?
Well, one of the challenges they have is they are drawing so much attention. So the narrative around these streaming services, what they're going to offer when, is very difficult for them to control, and that makes it pretty challenging for them to get the right message out around price points and when content's going to be available. As you know, as we were mentioning, we're already talking about content and networks that are going to be available in 2020, and that kind of mutes the conversation about what's available today.
One of the things you should think about is that the consumer really looks to one of these services to focus on. Like, you know, every streaming service needs to create addicts. The services that have one show or two shows that you're watching, you're not going to build that habitual daily behavior where you just go on there looking to watch something. So you may go on to Disney Plus because you want to watch Mandalorian, but Kurt, there isn't a lot for you to go on as an adult unless you want to go rewatch old Marvel or Lucasfilm shows. There isn't a lot to actually watch. And so when you're thinking about where do you build that daily behavior of going on to find something to be entertained, sort of like when you turned on your cable box and you scrolled through trying to find something to watch, I think that's what Netflix has really tried to create, where there's something for everybody. And there's always something new. There's always a new show coming onto the service. And they're trying to build that addictive behavior where every night you're going back looking for something new or continuing what you were doing last night. That's very different than most of these other services that are not really in that same game.
Rich, you mentioned the Mandalorian and the Disney Plus service. Obviously, Apple Plus is also trying to do a similar kind of big highlight shows to get people interested. I'm curious, how do you feel that those two in particular have really hit the market at the tail end of this year?
I mean, I think it's hard to deny that Disney Plus has been an incredible early success story. I mean, they've already announced 10 million subscribers on day one. Obviously, part of that is people who locked in multi-year deals and people who took it free through Verizon. But still, it's a staggering number. Kevin Mayer and the team working for Bob Iger on rolling this out did an incredible job, and they're probably heading towards 20+ million subscribers by the end of 2019. So in a couple of months, they will have added, 20 million subscribers. That's just a staggering number. Now, the question is, how do you grow from there? And I think there's obviously going to need to be a lot more programming in order to keep you interested. Remember, right now you're burning through a lot of library. People are going and rewatching Hannah Montana, rewatching Wizards of Waverly Place. When they get through that, though, they're going to realize that there isn't a lot of fresh content, especially for a more mature audience. And I think that's where it's really going to be interesting to see how much does Disney invest and how much are they relying on kind of legacy movies and legacy content, and will that really be enough to mitigate churn? We'll certainly see. Our guess is that you start to see Disney spend a lot more money and also collapse windows so they get their movies like Frozen 2, which just came out, won't be on Disney Plus for 6 months. My guess is those windows start to close.
That was Lightshed's Rich Greenfield and A.T. Kearney's Greg Portell. As 2019 was the year of the tech IPO, Uber also dominated the news, as it was one in particular that investors had been waiting for. It was supposed to be the IPO of the year, the ride-hailing startup that was supposed to be the world's most valuable, with a supposed market value of as much as $120 billion. But all of that changed during their debut, dropping nearly 11% in the first 2 days of trading. But while words like debacle were being thrown around to describe Uber's coming out party, CEO Dara Khosrowshahi remained optimistic.
You can't pick when you go public. You can control how you execute as a company, but believe me, we believe that our business can and should be profitable over time.
Promising that the time frame would be 2021, and people agreed.
Investors want profitability, and you'll get that here pretty soon.
I don't see it as the end of the road. I see it as an important milestone. I think it was an achievement in terms of making that company available to public investors.
But since then, the stock price has continued to take hits, including hitting a record low in November as Uber's lockup expired. And despite a licensing battle in London and an Uber report disclosing more than 3,000 sexual assaults on its platform in the U.S. last year, Uber remains optimistic.
The business itself can be quite profitable. We're confident of that. But the next 2, 3, 4 years are going to be about growth, and then we'll flip it over as the market demands.
Khosrow Shahi spent the year cost-cutting in significant ways, shedding 1,000 jobs and rearranging divisions within Uber. And after watching other companies like Lyft and Peloton look lackluster since going public, Khosrow Shahi's now thankful for that May 10th debut, telling listeners at the DealBook conference in November that, thank God we went public when we did. As for Uber's performance in 2019 and its competition with Lyft, I got perspective from D.A. Davidson Senior Research Analyst Tom White and Wedbush Analyst Yigal Arounian.
It's clearly disappointing. I think what Uber and Lyft, part of the problem was that they were slow to detect and react to how investor expectations around demonstrating a path to profitability would be clearer. And investor sort of expectations shifted relatively quickly. Uber and Lyft were slow to react, didn't really necessarily communicate very clearly that path, and investors punished them for it. I think the other thing that was interesting too here to keep in mind is, we've seen over the years, lots of high growth companies that went public when they weren't yet making money, but the IPOs were still relatively successful. I think in Uber and Lyft's case, and Uber's in particular, the sheer magnitude of the losses were something that investors struggled with. And I think that was a large function of how long these companies were private for before they decided to go public.
Yeah, Yigal, your take on the 35% drop.
Yeah, I think what you saw out of the market this year over the course of the year was less of a willingness from public market investors to accept large losses and unprofitability. Really a kind of a record-setting year with tech IPOs. Uber and Lyft were ones that kind of led the class. And I think all of that kind of IPO supply led to some technical challenges. You also had Lyft and Uber and others that the trend kind of turned to stay private for longer. I think that sucked up some of the demand when they came public. There were a lot of lockups that expired, and that led to a lot of supply. So there were a lot of technical issues at play, I think, as well. And look, Lyft and Uber kept facing headwinds and negative news. There was a lot of the regulatory issues, the London problems, and other things that they disclosed over the course of the year, and that kept sentiment low. We'll look to see if that can flip over the course of 2020.
That was D.A. Davidson's Tom White and Wedbush analyst Yigal Arounian. And still ahead, we've seen rampant cyber attacks in the past few years on both personal and institutional scales. What the threat landscape will look like in 2020, we'll find out next. This is Bloomberg. How to stop cyber threats? Cybersecurity concerns have been on the rise as data breaches frequently occur in spaces like financial institutions and social network platforms. With 2019 wrapping up and an election looming in 2020, I was joined by Proofpoint CEO Gary Steele Monday in this week's Work Shifting segment to discuss what the cyber landscape will look like next year. Proofpoint is a cybersecurity firm that helps companies worldwide stop targeted threats and safeguard their data.
I think the reality is the cyber concerns are increasing, not decreasing, because we've seen lots of very highly visible attacks. People need to improve their posture. And so I expect spending on cyber-related products and services to increase over the coming year.
You were talking about some 3 key trends that you see really going forward. The first of which is that they target people, not the infrastructure. How are they becoming more personalized, where more and more we get tricked, if you will?
Well, I think the reality is infrastructure broadly has become more secure. So what is more vulnerable is a person. So some type of targeted attack using some form of social engineering. And what does that mean? They just look at your Facebook account, they look at Instagram, they try to figure out something about you, and then they craft a lure that makes you want to click or engage in some way.
What do we do to stop it? Is there anything?
No, I think there's a number of things. So one is we provide security to help organizations block these kinds of threats coming in, identify and detect them and block them. We also do a lot of work helping raise the awareness of every single employee, because I think we can all be better at identifying ourselves and ensuring that we're not being lured into some kind of cyber threat or cyber attack. Because the unfortunate reality is if they attack you at work, they probably will attack you at home as well.
Well, the second point that shocked me was email. I thought we all knew how to ignore spam emails. How are we still getting tricked by emails?
It's the way business runs today, and so those are the kinds of attacks coming in. And if you just look back, 94% of all breaches come back to a single person. And the way they're being targeted is either an email or through some cloud app. Some way an employee is interacting with some cloud application.
We are fastly approaching those 2020 elections. What are the threats at this moment in the cycle of the election? What are the biggest issues at this moment?
Well, I think that in any time where there's some form of uncertainty around major events, like an election is a perfect example of that, you have a lot more participation by cyber actors. Because what they will do is create lures that are related to that particular event or that particular point in time. So the election's perfect for that, where people are going to click on something, be more susceptible to being lured into some kind of attack.
How are you assisting political campaigns in that?
So for us, what we're really trying to do is help all of our customers be better secure and secure their employees. And so we're very much focused on watching what threat actors are doing, watching where the market is headed, and ensuring that we're one step ahead of where the threat actors are.
Do you see similar threats like we saw in the DNC hack in Clinton back in 2016? Are those threats similar, and are we better prepared?
I think we're better prepared, but the attacks are probably more sophisticated today. And I think that as we enter the election year, you're going to see a lot more participants more broadly in the threat environment. So everything from state actors to organized crime to anyone trying to take advantage of another person.
What do we do to prevent, I'm not thinking hacking on our voting machines, but more bigger, a utility, a power grid? Is there anything to do to prevent those, which fortunately have been fewer in the U.S.?
No, I think there's broader awareness today across all those organizations. They are raising the awareness of their employees. They're improving their infrastructure. And I think that going back to the first point we made is the thing that's most vulnerable today is people, because that ultimately is the root of any kind of breach that ultimately happens. And so organizations are thinking hard about how do they better defend their people, because they're the key to unlocking what's behind those doors.
Any big change we could make today to help the election in 2020? Keep it safe.
Well, I think that everyone needs to be vigilant, because if you look over the course of the last 18 months, $26 billion have been lost as it relates to even a simple category of business email compromise. And so the motivation and the incentive is there for threat actors. And so I think we all as individuals at work and at home need to be more vigilant.
That was Proofpoint CEO Gary Steele. And that does it for this edition of the Best of Bloomberg Technology. We bring you all the latest in tech throughout the week. Tune in each day at 5 p.m. New York and 2 p.m. San Francisco. And Bloomberg Technology is live streaming on Twitter. Check us out at Technology, and be sure to follow our global breaking news network at Quick Take on Twitter. This is Bloomberg.